Thank you so much to Eri Masostru-Savills for your presentation there. I think commercial real estate and its implications for covered bonds is going to be one of those things that we're going to keep coming back to in the coming years. If you missed Eri's presentation, please do take a look at it. Like all of the content over these 3 days, it's going to be up on the platform for another 30 days. Please do visit, check that out. Another topic that we're going to be coming back to, and a topic very close to my own heart, is the role of covered bonds in developing markets. There's a clear need for funding outside the traditional centres of our market. There's a clear opportunity to get bonds which actually have a positive yield. And there are lots of complicated, lovely structuring problems. What's not to like about all that? To help me discuss this topic, I'm delighted to be joined today by two faces that are going to be very familiar to you if you've been paying attention in the last few years. Colin Chen, the head of Structured Debt Solutions at DBS, is also the chair of the Association of Banks in Singapore's Standing Committee on Covered Bonds, and most importantly for today's purposes, is the chair of the Global Issues Working Group of the ECBC. Jacek Kubas works in local currency capital markets development at the ECBC. That encompasses all sorts of instruments, sustainable finance, fintech, derivatives, but most importantly, for our purposes, covered bonds. The ECBC has been at the forefront of developing and enhancing covered bond laws throughout its region, Central and Eastern Europe and beyond. So, gentlemen, thank you both for joining me today. Colin, can I start with you? One of the problems that I keep hearing in new countries, particularly in the post-COVID era, is we've got lots of deposits. Our loan-to-deposit ratios are well below 1. We're not lending enough money. We're taking in too many deposits. Why do we need covered bonds? Singapore's obviously got a very high saving ratio. When you introduced covered bonds in Singapore, what was your response to that?
Well, thanks very much, Richard, and good morning, everyone. When Singapore first introduced covered bonds, I think the journey towards actually getting the regulators and the banks themselves to be actually looking at it was a long journey and was not an easy conversation, as you can imagine. And I think true to this day, the deposits continue to be, the system continues to be flush with deposits, and banks' original intent and belief in covered bonds holds true, which is it offers a way of diversifying from their sources of funding. It is strategic in that sense, where it offers banks the ability to diversify and access investors which would not naturally be investors in their usual issuance programs. So from a systemic standpoint, the authorities also felt that this would be a good way of ensuring that there would be what we call high quality access as well as high quality investable instruments to basically show up the liquidity pools in institutions.
Driven by the authorities rather than by the banks themselves.
Sorry, lost you there.
But initially the drive came from the authorities saying that that's appropriate rather than from the banks, or from a bit of both?
I would say that authorities wouldn't naturally introduce any new initiative unless there would have been some interest. So I think it was, let's just say, the entire industry coming together, the banks, through the Association of Banks in Singapore, working with the authorities to ensure that there's sufficient research, there's sufficient justification, exposure, and consultation in terms of the use of covered bonds. So I think as we all know, since the introduction of legislation, all the 3 local banks have established their own covered bond programs. And I think, with fingers crossed, we should be able to see a couple more come our way in the sense of the locally incorporated foreign institutions.
And Jacek, you start the dialogue typically with the Ministry of Finance or sometimes the central bank in a country, but also you have this problem of a lot of deposits,
Yes.
very low loan-to-deposit ratios, very small banking compared to GDP.
Absolutely.
What's the experience?
Thank you. Yes, thank you, Richard, for the question. And I agree to what Colin said, because really when we start talking to the banks in the EU countries we operate, which will be Central Eastern Europe and part of the Southeastern Europe, they are really very often deposit funded, quite liquid, and they are not very interested at the beginning in cover bonds. So there is always a lot of conversation with the banks explaining why it is important to have an instrument in their portfolio that provides term funding, and that is a safe and stable instrument that investors, including international investors, are really interested in. And when we, as you, Richard, mentioned, start those conversations with Ministry of Finance or even a central bank, they look at it from a very different perspective. They still remember cover bond as being the safe instrument that went through the financial crisis, even though it's been such a long time since then, and so much the world has changed. But they really see benefits of that. And we also know with the EU directive and implementation, some countries are working on introduction of cover bonds that even didn't have that framework before. But we do a lot of conversations with the banks to really explain to them why it is useful. And I see a couple of elements in addition to the term funding and all the other features of the cover bonds that are actually important in the global scale. First of all, in the countries where we work, which are still very developing and growing in terms of the GDP and sometimes still population, is the issue of housing market. And loads of houses are being built, and there is a need for mortgages for those houses, and also the introduction of some of the fixed term mortgages in those regions is starting. So the cover bond instrument is becoming very useful. Secondly, looking into that, we have a lot in our jurisdictions of a new build apartments, which are energy efficient and are good to be a pool for green cover bonds. And we saw that in a number of countries where we operate, where the issuance of green cover bonds happened, like, for example, in Poland, before the issuance of an unsecured green bond happened. So that's quite an important element of also convincing them that they could go for the route of green cover bonds. And it not always works so well because, for example, in Romania, from the moment we did the reform, and Richard, because you're also involved in that work, it took 3 years for the Alpha Bank to issue cover bond, and we haven't seen another bank coming yet, which I hopefully we will see that coming soon because the liquidity in the banking sector. And that's another argument that we have also in our reforms where we're discussing with our counterparts, for example, in Bulgaria at the moment. So there is a little bit of a balance and explanation of the financial institutions why this is a good instrument to have. Of course, we also live now in the environment with MREL and other elements that take priority. But I hope that in every country we do the reform, not only one but more banks, like mentioned by Colin in his jurisdiction in Singapore, will also come and issue cover bonds because we, as a bank, believe that this is a good instrument to develop the market.
We all agree with that. I think one important point there is it did take a very long time in Romania, actually a couple of years before the law was passed, and then 3 years before the first deal came. These are long-term instruments, and yes, loan-to-deposit ratios can turn around quite quickly when mortgage markets grow. And know that in Poland, for example, the mortgage market tripled over the space of 10 years, and that really starts to affect it. But staying with Poland, another one of the dilemmas, another one of the topics which comes up is, look, are we doing this for the development of local currency capital markets, which I think is what it says on your business card, or are we doing it to feed the euro engine to attract foreign investment?
Thank you, Richard. I could have easily escaped that question by saying that my department is called now Capital Market Development (CMD), and the local currency element is dropped.
You dropped
But
that,
that's
okay, I
not.
didn't realize
But
that.
that's not something that's going to excuse me in answering this question because we still believe in development of local currency capital markets for a number of reasons that we all know because we are all capital market related professionals. And that's what very nicely started in Poland. That we had a bank, which was PKO Mortgage Bank, that the first cover bond issuance was in Polish zloty in the market, was not really big in terms of the amount, but was to test a couple of years ago, which we invested as a bank, and we supported their local domestic issuances. But we've also supported the issuances in euro because we believe that that helped developing the market. That helps to attract different investors to the market. So some of the investors that may not have looked into Poland or other countries where we work on would start looking into this market. Of course, some of them don't want to have exposure to Polish zloty, and that's where the euro was very handful for them. Those also, of course, need a swap in the structure. But then we also look at some of the other markets because I think this local currency element, at least for us, selfishly in our region, is only available for the few markets. The other one is Hungary, which we know that over 10 years ago, all of the FX mortgages were turned into the Hungarian foreign mortgages. So there is a need only for the local currency funding. While in Poland, still we have some mortgages that were still in the foreign currency, mostly Swiss franc or euro, and they are still being there. So that's good to have that currency's issuance in portfolio for the bank as well. And then we have some other markets like Estonia, Latvia, or Slovakia that are euro already economies, where that issue does not exist, and we could see how quickly and well it is all then develop in those jurisdictions, which we also support. And now, interestingly, we're working with two countries, Bulgaria and Croatia, that are both in their way to become the Euro member states. And what is inside me is the question: are we going to see any of the cover bonds in Croatian kuna, or are we going to see cover bonds in euro, because the mortgages are still in euro and the country is heading towards that? So I think both are important for the development of the market, and I think the instrument itself, whether it's issued in local currency or it's issued in the FX currency, is developing the market itself, subject to also in terms of the portfolio of mortgages, right? Whether the mortgages are in euro and other currencies, because many of our countries of operations are still doing that. Although we see the much bigger increase of local currency mortgages compared to a couple of years ago.
And Colin, obviously the Sing dollar capital market hardly needs developing. It's an extremely sophisticated, developed market. But still curious to know when we're going to start to see proper issuance in Singapore dollars of covered bonds. And then related question, what about other countries in the region, or well, the Global Issues Working Group? What about all of the other new countries looking at the product? Well, I guess it's an obvious example.
Well, thanks for the question, Richard. I think, as using Singapore as an example, again, we are flushed with, we are in a position of excess liquidity via deposits for most of the banks. So with the issuing banks requiring funding in Sing dollars, that's possibly not the case. But in terms of reflections, I think you might also want to think about, the developing markets and investors' access to those so-called local currency denominations, Sing dollars, Korean won, Indian rupee, for example. Would they be able to fund the investments in these currencies? That's one end of the bookshelf that you might want to think about. But I guess back to Singapore, I would think that for the other institutions who may not have ready access or as ready access to Sing dollars and needing to fund their business in Singapore, I think they would consider certainly issuing coverage in Sing dollars. But I guess for the three local issuers to date, the incentive to issue in Sing dollars perhaps may not be as large or may not be as pronounced.
You mentioned very briefly there India, and India is one of the interesting examples of another topic that we keep coming up against of how much do we need cover bonds in developing markets to follow the European model, and how much do they follow specific needs? Now, it's been very much under the radar screen, but there is a covered bond market in India. I don't want to be too disparaging about it, but it's very different from what we see in Europe. Underlying assets include gold loans and auto loans, for example, entirely domestically placed, but labeling itself as a covered bond. General question of how do we achieve a right balance between what it says in the covered bond directive and the very specific needs of all of these emerging countries?
Oh, that's an excellent question, Richard. I think the key to that is the word balance. I think in many of these developing jurisdictions, there is a difference in the legal and regulatory regime, which may affect how one constitutes the asset pool, the asset segregation behind asset pool. And where I'm leading towards is that we have attempted through the directive at the Basel level, attempted to have a principles-based definition of a covered bond. And within those definitions, it specifies the assets which would fall into a covered pool or be eligible for the covered pool. Now, that's probably the top shelf of what a covered bond should look like or might want to be construed, but certainly from a regulatory perspective, that is how one defines what a HQLA eligible asset will look like. We've seen many of the other jurisdictions, developing jurisdictions, throw in other forms of what we call loans aside from mortgages. And that's interesting as well, because even within Europe, we've seen the evolution of the ESN, and it adopts the covered structure, but it doesn't call itself or label itself as a covered bond. It will have its own, I would say, treatment in terms of what the ECB treats of it from a repo standpoint. Perhaps it may not qualify for HQLA. These conversations are ongoing, but I think many of the developing countries and developing jurisdictions will probably have to take a leaf out of this from a guidance standpoint, because a covered bond has certain principles which needs to be kept to in order to fulfill its defining profile under the regulatory oversight. And the regulatory oversight sits from the Basel Committee across to all of the regulated financial institutions. So I'm not sure whether I've answered or I've attempted to answer the question, but the key here is really balancing it all.
That's a horribly open-ended question. So I appreciate your thoughts. And I suppose the other point, and I'm going to make it because you're too modest to, is that the global issues working groups that you chair, there's a lot of work helping issuers in new jurisdictions. Ejek, so within the European Union and your countries of operation, presumably it's much easier because you have the Covered Bond Directive as your playbook. So more straightforward?
I think it is, and we even started working before the directive was there. And I remember, the first set of EBA principles and how we were checking the countries versus, green, yellow, and red light for the principles there. But even though, and we had EBA principles, and I underlined the word principle, and I think it's the same with the directive. It's a principle-based directive. So we still need so much of legal and regulatory framework in terms of development of cover bonds. So just to explain to all of you how we work with our member states is we don't come to them with a copy-paste solution of what you have to do, but we always also work with local law firms to make sure that we address the relevant issues, whether these are in the banking law or they may be in the insolvency legislation or any other legal regulatory framework that is relevant to a cover bond, because every country is different. We have the different frameworks, and we have to make sure that within those different frameworks, the features that we are interested in this instrument and to the features that make this instrument really a brand that is so recognizable across the world, right? From Canada to Asia through Europe. So how we make sure that this is being preserved. And we are, in our reforms, I think, quite conservative in terms of the eligible asset classes. I think in our countries of operations, only in Turkey, where SME loans are also eligible, because that's what the Turkish law provides for, and one of the banks did issue that for a while. But we hear more and more from the reforms that we're doing right now and looking into the economical shift and change post-pandemic, that the banks are getting more interested in applying the structure to the SME. So that's great that Colin mentioned the European secured note. But I wanted to really underline that it's not a one-size-fits-all solution, even though we have a directive or principles or any guidance, but really making sure that things work well in the local legal system. And very often with the Ministry of Finance, the conversation may be quite easy in a way, because they understand the financial elements and models, but you may have to talk to the Ministry of Justice, for example, in changing the bankruptcy legislation elements. And that's where the conversation becomes very, very difficult, because they're specialists in bankruptcy law and they're amazing lawyers very often, but then they don't know financial structures and complex structures, and how you explain to them that what you're trying to create here is actually valid and good and reasonable. And that's one of the really exciting elements of the projects. And I know, Richard, because you work with us on so many of them, that you enjoy those conversations too.
I do. We've had those conversations everywhere from Kiev to Zagreb over the years, and it is a fascinating area. One area though that I'd like to go outside the ECE region, and a topic which keeps coming up, particularly in Central Asia and to some extent in Asia, is this idea of we'd like a national mortgage agency, Fannie Mae for want of a better comparison, as an alternative to covered bonds, a state-sponsored mortgage agency. Is that a rival for covered bonds? Is it an alternative? Are they complements? How do you view these?
Who are you asking, Richard, first?
Yes.
Is that me or Colin?
Start with you, then ask Colin the same question.
Okie doke. Happy to take that one. I'm still a little bit half undecided in that regards, and I'll tell you, explain why. So we started venturing out with our reforms outside the EU. So most of the projects we did was within the European Union. Now, for example, we are advising on covered bond legislation in Ukraine, but more importantly, because it's more active, we are advising in Georgia. And of course, we are looking into the directive. We want to make it complementary to what the principles are, and hope that maybe in the future receive the third party recognition, etc. But what is quite difficult there is that the market is small. And then how are you going to make sure that those banks can maybe come together and issue something that will be a benchmark size or sub-benchmark size, because without that, they may not be able to do. And I think what the conversation is, it's a little bit about what kind of pooling model or system we could do. And for example, in Georgia, the Georgian authorities were exactly talking about that type of agency. Such type of agency also is in Armenia and is in operation. And that's coming from what at the beginning of 90s or mid 90s, there was a lot of aid also in those jurisdictions coming from the US, and to set up the mortgage market, those agencies were provided. But we know that US is not the number one in terms of the cover bond markets, right? So is that going to be relevant for the issuance of cover bonds? Because I personally think that the banks should be issuer of that instrument rather than any other entities. But the struggle is how you make sure in the smaller jurisdictions that there is a accurate size of mortgages and that the issuance can be of interest to international investors if we go with the foreign denominated issuances. And that's where I start to look more open-minded to that structures that would provide for that. But that's the only reason in that regards.
Mm-hmm. And Colin, obviously, there's some extremely successful mortgage finance agencies. I'm thinking in Malaysia and Korea. Do they hold back or do they complement covered bond development in Asia?
Well, I think very much. I think just I brought up a key point, which is about size and efficiencies that come with it. So I do think that this in a developing market where these mortgage agencies where they exist, it complements the market in the sense that it is able to then aggregate the mortgage pools and for the ability to create more efficient financing pass-through to the banks in the system. Korea Housing Finance, purchases the mortgages. I think Cagamas in Malaysia does the same in terms of purchasing the mortgages from the banks. Again, Hong Kong Mortgage Corp does the same. Many of these so-called mortgage agencies in Asia and developing Asia operate under this pretty much the same construct. So I do think it does allow for covered bonds to be issued by these agencies in a way in order to pass through the efficiencies of financing it. Only because individually these banks may not be of a sufficient size or may not be able to reach benchmark, and therefore will probably constrain or constrict their ability to issue coverage or even for investors to accept them as eligible investment instruments.
I suppose that is a debate that we have had in Europe with the pooling models, the CRH type models, which are generally widely accepted as covered bonds. But yeah, they are essentially pooling agencies, whether they're private or public sector, whether they have government involvement or not. So we do have precedent for that. I'm actually deeply frustrated because we unfortunately already have run out of time. It feels like we've been speaking for 5 minutes, but apparently not. Apparently we have run out of time. So many apologies for that. We could do an entire panel on this, and I suspect at the next conference we probably will do. Achet, Colin, thank you so much for joining us today. It's a fascinating subject. It's one that we're going to keep speaking about, I'm sure. Please don't go away, or go away for 20 minutes if you like to get yourself a coffee, but please make sure that you are back in 20 minutes where we are going to be going to UniCredit's workshop. Franz Rudolph is going to be hosting a workshop on the rather dark topic of covered bonds in the shadow of COVID. Won't be as depressing as it sounds. Thank you so much for watching this. Thank you again, Colin and Jacek. See you soon.
Thank you,
very
Richard.
much. Have a good day.